Samsung. 7 Secret Side Hustles CPAs exposed to high net worth clients only. My accountant friend showed me the exact income streams his 500K plus clients use to legally hide money from the IRS. And when I say hide, I mean strategies so aggressive that when he first explained them to me over drinks, I genuinely asked him if this was legal. His response? Legal. These are the same structures my clients use to pay 12% effective tax rates while their employees pay 32%. Last week, I finally convinced him to walk me through all 7. And the 4th one on this list? That one alone is responsible for more quiet millionaires than any crypto pump or stock tip you've ever heard. Here's what nobody tells you about wealth in America. The rich don't have better jobs. They have better information. They have CPAs who charge $400 an hour specifically because those CPAs know income streams that double as tax shelters. My friend has been doing taxes for high net worth individuals for 11 years. His average client makes $847,000 per year, and I'm about to hand you the playbook they pay him to protect. We're going to cover 7 specific side hustles, but pay close attention to number 5 because it's the one his clients guard most jealously. It requires almost no starting capital. The IRS actively encourages it, and it compounds in a way that makes traditional investing look like a joke. But first, let me show you the foundation that makes all of this work. The first side hustle his wealthy clients almost universally share is something called equipment rental arbitrage. Now, before you click away, thinking this is some boring leasing scheme, let me tell you about Marcus. Marcus is a 34-year-old software engineer making $185,000 a year at his day job. 2 years ago, his CPA suggested he buy a $47,000 excavator. Marcus has never operated an excavator in his life. He doesn't know what an excavator does. But here's what he does know. That excavator generated $68,000 in rental income last year through a platform called Fat Llama and direct contractor relationships. Now here's where it gets interesting for your taxes. That excavator qualifies for Section 179 depreciation, which means Marcus wrote off the entire $47,000 purchase price in year 1. So his first year, he showed a $47,000 loss on paper while actually pocketing $21,000 in real cash flow. His effective tax rate on that income was negative. The IRS paid him to make money. The reason wealthy people love this is scale. Marcus now owns 3 excavators, 2 scissor lifts, and a concrete mixer. Total investment of $156,000. Annual rental income of $203,000. And every single piece of equipment is a depreciating asset he writes off while it simultaneously makes him money. You don't need construction equipment specifically. His CPA has clients renting camera gear, medical equipment, and industrial kitchen appliances. The formula is simple. Find equipment that businesses need temporarily, buy it, rent it out, and let depreciation do the heavy lifting on your taxes. The second side hustle is one that made me genuinely angry when I learned about it because it's been hiding in plain sight. It's called royalty income stacking, and it's not what you think. Forget writing books or making music. His clients are buying royalties. There's a woman named Patricia in his client roster who spent her career as a marketing director. She retired at 51. Not because of her salary, but because she spent 15 years quietly purchasing mineral rights in West Texas. She'd find landowners who needed quick cash, buy their mineral rights for a few $1,000s, and then collect royalty checks when oil companies drilled. Her total investment over 15 years was about $340,000. She now collects $127,000 annually in completely passive royalty income. And here's the tax angle that makes CPAs salivate. Mineral royalties qualify for the depletion allowance, which means 15% of that income is completely tax-free. Every year. Forever. But Patricia's strategy is old school. His younger clients are doing this digitally. There are platforms now where you can buy fractions of music royalties, patent royalties, even pharmaceutical royalties. One of his clients bought a piece of a pharmaceutical patent for $12,000. That patent generated $4,800 last year because a drug company has to pay every time they manufacture a specific medication. That's a 40% annual return, and a portion of it is tax-advantaged as a royalty. The key insight here is that wealthy people don't trade time for money. They buy assets that generate money while they sleep. And then they buy those assets in categories the tax code rewards. The third side hustle is where we start getting into territory that will change how you see money forever. It's called short-term rental arbitrage with cost segregation, and it's responsible for more accidental millionaires than almost anything else in his client book. You've heard of Airbnb arbitrage, right? Renting apartments and subletting them on Airbnb? That's amateur hour. His clients buy properties specifically designed to lose money on paper while generating massive cash flow in reality. Here's how. His client David bought a $280,000 cabin in the Smoky Mountains. That cabin generates $78,000 in gross rental income per year. After expenses, he nets about $41,000. But here's the magic. His CPA ran something called a cost segregation study, which breaks down the property into components. The appliances depreciate over 5 years, the carpeting over 7 years, the land improvements over 15 years. Instead of depreciating the whole property over 27 years, David accelerated $112,000 in depreciation into year 1. That means on paper, David lost $71,000 on this cabin. In reality, he pocketed $41,000. And because of something called the short-term rental loophole, if you actively manage the property for at least 100 hours per year and more than anyone else, those paper losses can offset your W-2 income. David's day job pays him $165,000. His effective tax rate dropped from 28% to 19% because of one cabin. He now owns 4. If you want more strategies like this, hit subscribe. I drop one of these every single day. Now here's something most people don't realize. Creating content about these strategies is itself a business. I actually use a tool called 11 Labs for voice work in my own content creation side hustle. You can check it out at https try 11 Labs IO 2PU1092JL1. But the real money isn't in the content. It's in applying what you learn. The fourth side hustle is something you can literally start today with $0. It's called strategic consulting income structuring. And before you roll your eyes at the word consulting, hear me out. His client, Jennifer, was a project manager at a tech company. She made $95,000 a year. Her CPA noticed she had skills companies would pay for, not as an employee, but as a consultant. So Jennifer created an LLC, found 3 companies who needed project management help for specific initiatives, and charged them $150 an hour for 10 hours a week. That's $78,000 in additional annual income. But here's the part that matters. As a consultant with an LLC, Jennifer can deduct her home office, her laptop, her phone, her internet, her car mileage to client sites, her professional development, her health insurance premiums. Things she was already paying for suddenly became tax deductions. Her effective tax rate on that $78,000, 14%. Her tax rate on her W-2 job, 28%. Same person, same hours, worked. Radically different outcomes just because of how the income was structured. The action step here is dead simple. What do you know that companies would pay for? Write it down tonight. Now here's the side hustle most videos will never tell you about because it sounds boring. It's called private lending, and it's the fifth strategy his wealthy clients use religiously. Forget the stock market for a second. His client Robert took $80,000 and became a private lender to house flippers. He finds flippers through local real estate meetups, evaluates their deals, and lends money at 12% interest secured by the property itself. Robert made $9,600 in pure interest income last year on that $80,000. And because the loans are short-term, usually 6 to 9 months, his money isn't locked up for decades. Here's what blew my mind. Robert structures these loans through a self-directed IRA. That means his $9,600 in interest grows completely tax-free inside his retirement account. He's not paying a dime in taxes on this income. The wealthy understand something most people don't. The safest investments aren't in the stock market. They're in secured lending, where you hold the collateral. If the flipper defaults, Robert gets a house worth more than what he lent. His worst-case scenario is owning a discounted property. The sixth side hustle moves fast, so pay attention. It's called the Augusta Rule, combined with a legitimate content business. The Augusta Rule, Section 280A, lets you rent your home to your own business for up to 14 days per year, completely tax-free. His client, Rachel, runs a small online business. She rents her own home to her business for $1,500 per day, 14 days a year, for things like filming content, hosting team meetings, and client consultations. That's $21,000 in tax-free income. Her business deducts it. She doesn't pay taxes on receiving it. It literally disappears from the tax code's perspective. The seventh strategy ties this all together. It's called income stacking with strategic entity selection. Remember Marcus with the excavators, David with the cabin, Jennifer with the consulting? They don't have 7 different businesses. They have one holding company with multiple revenue streams feeding into it, managed by one CPA who sees the whole picture. This is what wealthy people actually do. They don't pick one side hustle. They build a portfolio of income streams that each serve a different tax purpose. Real estate losses offset W-2 income. Equipment, depreciation shelters, rental profits. Consulting deductions reduce effective rates across the board. Look, I started this video telling you about income streams wealthy people use to legally